All right, guys. Today is the Fed rate hike decision. Uh, Let me know what you think we're gonna get. We're gonna do a poll here. I'm getting everything ready. Bear with me here. Um, yeah, let me know what you guys think is gonna happen here. The SPY breaking down to under 398 right now. I think a lot of people are waiting for the Fed rate hike decision to happen because a lot of people are just nervous. So I doubt people are going to be taking really large position sizes today. And a lot of the time when stuff like that happens, it's pretty sideways and choppy here. You can see the SPY starting to break down. We got Carvana up. I'm gonna put just the SPY and Tesla here. So we got we'll put the SPY up there. We can put the Q up actually on the left here to see what the Q's doing. Tech doing a little bit better than the actual market, but pretty flat day so far. And we're gonna get ready to play some music as well. Before we do any of that, though, we're gonna do a poll like we always do. How will the market react to today's rate hike decision and press conference? Positive reaction, and then we're going to do a negative reaction option. I could ask people how much they think the Fed is going to raise rates, but I think a large majority of people are thinking 25, like I am. Positive, negative, neutral. Put on this poll right now. I think that's probably the most reasonable poll to do. What's up, David? Black, K, Shepherd, E, Fish, Bar. We got the poll live as well. Yeah, the VIX is probably moving up. I think the SPY is probably moving down. But again, the market's up so much over the last 24 hours that we're probably just correcting a little bit ahead of the rate hike decision. I don't know how the market's going to respond. This is one of those rate hike decisions where I genuinely have no idea. Again, SPY down under 398. Q was pretty flat. Q was kind of straddling the previous closing price. So it's pretty flat. Um, Not a ton going on. Neutral, yeah, let me know. Again, we're going to get our poll live on Twitter as well if you want to vote on that poll. But yeah, we got about 54 minutes. You can see the number here at the bottom, 54 minutes. Yeah. I don't know if the bottom is in or not. I think we're actually up a lot over the last 10 days here. We zoom out. We're actually pretty flat over a 10-day period. So all the sensationalism that went on over the last 10 days, to be honest, and really interesting. Here's the market over the last 10 days. That's the trend of the market over the last 10 days. I might be able to draw this better, but that's the trend. We're pretty flat. We're going to do a poll on Twitter like we always do as well. All right. All right, we got Jerome Powell. We're going to do a poll. All right. How much does the Fed raise today? 0, 25, 50, or something else? Yeah. Hit the like button as you join the stream if you can, guys. We appreciate it. Flat 25. Pause. I don't think we're gonna pause. I think it'll almost certainly be 25 in my opinion. But of course, you don't really know. You can see tech starting to move up with the Q bouncing. Uh, but I think the most likely outcome is 25 basis points. The real question is how does the market react to the announcement as well as how does the market react to the press conference? Like, how is Jerome Powell going to speak on this stuff that happened over the last month or so, really? And so, a lot of people are speculating whether it's going to be good, bad, bad, good. They don't really know what's going to go on here with this. So, you know, we'll see what happens. But yeah, all right, we're gonna go ahead and play some music here. Bear with me. Let me know if you can hear the music. Also, be a test of my microphone to make sure. Press conference is going to come in. Do you think we pause? Let's look at the numbers so far in the poll. 43% think we're going to react positively. 23% think we're going to react neutrally, and 33% think we're going to react negatively. Honestly, this might be one of the biggest switches that we've gotten from this one to last one. The last one, everybody thought we were going to crash, right? This one, it looks like the majority of people out of 200 plus votes already. I think we're going to have a positive reaction, which I don't know. I don't know. I think Jerome Powell is going to play damage control a little bit today, which what I mean by that is like with the banking disaster going on over the last 2 weeks or so with Silicon Valley Bank, First Republic Bank, Signature Bank, all the stuff going on in banking over the last couple of weeks. I think Jerome Powell is going to play damage control and say optimistic things. I think they'll probably do 25 basis points, and I think he's going to say optimistic, positive things regarding the economy to hopefully protect it from some of this banking contagion that we've had over the last couple of weeks. I think that makes the most sense, although, of course, I have no freaking idea what he's going to say. I don't know what the market is going to react to. I am just speculating and guessing here and have no idea what's going to happen, but that's my guess if I had to choose. Yeah, I feel you, Ace, but I think 0 is going to make people too much. Listen, I think 88% of people think we're going to go 25 today, including the big banks and analysts. I think that's the biggest potential tell, to be honest. I think that's the biggest potential tell. But, we could. About 13% of people think we're going to go pause. It's not going to be a full-on pivot. It's just pausing to 0, and then we'll probably resume it in the next 6-week period. But I think it's probably going to be 25, but I think there's a chance that it could be 0. I think if it's 0, the market's going to love it, obviously, and the market's going to fly up. But I think it's going to still cause a lot of inflation problems moving forward. If we go to 0, I don't think 50 is possible. I think 50 is possible. Anything's possible, of course. I don't think 50 is very likely. I think 50 would be like throwing gasoline in a fire right now with the banking problems going on. And so that's very unlikely, although of course it could happen. I'm sure if we do 50, some people are going to be like, see, I told you so, and maybe y'all are right. I just don't think that's going to happen. I think probably 25 is what's going to happen, but again, no idea. We'll see. Can y'all hear the music? You should be able to. Powell's a dove. Maybe, man. But yeah, it's a big stream. Should be fun. We'll see what we get from it. Still got about 50 minutes. We got the timer on the right side. 25, I predict the future, so I know what it is. Hey, at least you're not saying there's a leak. Every time we get a big economic release, somebody comes in saying, oh, it was leaked. I know it. You're usually wildly wrong. They would have accidentally got it right at this point. But again, usually they're wildly wrong about what the number actually comes in as. So yeah, it'll be interesting to see what we get regarding the rate hike and all that stuff. Again, I think it's going to be 25. I think the most likely outcome is 25, but of course, who knows, man? We'll see. How will Bitcoin react if it's 50? Bitcoin's probably gonna. I don't know. I think that's a little bit more speculatable. I think it could go both ways, to be honest, with Bitcoin. I think 50 is going to be bad news for banking, which might be positive for Bitcoin, but 50 is also going to be a pretty aggressive slap of rate hikes that might discourage the market in general. Sometimes the Bitcoin market, a lot of the time, in fact, the Bitcoin market follows the S&P 500. And so there's a chance that both of them help or hurt Bitcoin. I really don't know. I think that's a little bit more nuanced than normal, but yeah, I really don't know. We'll have to wait and see what happens. Here's Bitcoin right now. Bitcoin has not been following the market today. So Bitcoin has been trending against the market. So it might be something where more rate hikes are better for the crypto market. But again, speculating, I'm really not sure here. I don't think a bear market is only 1 year, and that's standard. But I think I understand the bear market could continue indefinitely. You know what I mean? Like, I understand bear market, again, after the 2000 boom and bust of internet bust in 2000 when the market crashed, it took 5-6 years to come back, and it was in a bear market for most of that time. So I understand bear markets don't necessarily only last a year. What I'm saying is that we haven't crashed yet, and so I think people are getting a little bit ahead of themselves in that regard. But again, we could crash today. If we're going to crash, it could be today. I'm not saying it is. I'm not saying we're going to, but if we are, it's going to be on a big day like today usually. But the way we would crash, in my opinion, is if the Fed came out really aggressive with rate hikes. That spread to banks. Banking sympathy affected other banks, and then the market essentially started dumping down from that and broke lows. That would be how we crash, and it's possible. I mean, like I said, I'm not saying that's not going to happen. I really don't know. The Fed meeting starts at 2:30, but the actual rate hike decision is announced at 2. So Powell makes his announcement at 11 a.m., but why do all his media peeps have it set for 11:30? Are they not going to broadcast the decision and only show the press conference? Yes. So yes, that's exactly right. So this is the procedure of it. Okay, every 6 weeks they do the rate hike decision. It's at the same time every time, which is at 2 p.m. in 45 minutes. Right at 2 p.m., they're going to release the decision on the Federal Reserve site. And again, I'll interpret it for you guys. Thousands of people will be here for that because we cover it very quickly, right? So you can either dig for it yourself and take longer, or I can show it to you guys as soon as I find it, which would be very fast. I'll also show you in a little bit later how you find it yourself if you really want to look it up and how to do it. But basically, it goes live on the Federal Reserve website at 2 p.m. Via HTML PDF file that you got to read and look for the specific part in the report that says how much they're raising rates. What the heck is playing right now? And so at 2 p.m. that PDF/HTML file or report will go live, and then at 2:30, Jerome Powell, Big Papa, will do a press conference, basically detailing what the rate hike was, why they chose to make that decision. He'll give his comments. They'll do a Q&A. That's how it works. And then weeks after that, they do what's called the FOMC minutes report, which is a little bit more thorough breakdown on why they chose to make this decision. That'll happen in about 2.5-3 weeks, if I remember correctly. So, hey, Michael, my guy, thank you, brother. I appreciate it. So 0 to 25. I don't know. It's not that. It's more nuanced than that, Michael. I would love for that to be easy interpretation, but with this type of stuff, you don't really know how the market's going to react. And in a lot of the last Federal Reserve rate hikes, the market has been neutral, I think. So it's never a for sure reaction, brother. It's never a for sure thing. 0 will almost, I think 0 will probably make the market fly up. But again, you never know for sure. 25 is neutral. So 25 is a question mark. 25 is this. If we do 25, You know, we don't know what we're gonna do with the market. We don't know whether the market's gonna go up, down, or sideways. If it's 25, it'll probably be kind of neutral or flat leading into when Jerome Powell speaks, and then depending on what he says, if it's positive or negative, you know, dovish or bearish, dovish or hawkish, bullish or bearish, however you want to, you know, interpret it. That'll move markets. You know what I mean? But up until then, 25 is technically neutral because it's what's expected. It's what everybody else expects. So in that regard, it's neutral. 50 is more aggressive, which is going to be seen better for long-term inflation problems, but worse for stock market movement in general. And the whole reason the Fed raises rates is to discourage spending, i.e., you know, the market to a certain extent. And so when the Fed, the whole tool the Fed uses to control inflation is by raising interest rates. When they raise interest rates, spending stops. And spending stops universally in everything, or at least it's supposed to. And everything, essentially, hopefully. The more aggressive, the more quickly spending will slow down. When spending slows down, businesses and other, you know, prices have to fall down in order to remain competitive, and thus it combats inflation and price problems. It's not a perfect science for sure. That's the theory of it. But again, it's never an exact thing, and you never for sure know exactly what's going to happen. You know, most of the time, right now especially, we're kind of in this really, you know, if it's zero, people are going to be really worried about inflation. If it's 25, some people are going to be worried about inflation. Some people are going to be worried about a recession. If it's 50, people are going to be really worried about a recession and banking contagion spreading and all that stuff. So it's a, like I said, this is one of the more interesting rate hikes that we've had in a while because it's almost a lose-lose situation, in my opinion. You know, I think no matter what we do, people are going to still be upset about it. And so, you know, again, we'll see what happens, but it'll be interesting. 25 is good for markets. Now, yeah, I agree. I would do 25. I think that's the neutral, balanced approach. But of course, you got half the people here yelling about 50, you know, or whatever they want to do. So, yeah, it'll be interesting. Yeah, all good, man. I appreciate the donation, bro. All good, man. All right, let me see. The music stopped. There we go. I don't think we're gonna do 50. Yeah, I think 50 is incredibly unlikely. It's possible, but it's pretty, you know, it's pretty unlikely, I would say. Again, my guess is that we're gonna do 25. I think 25 had like almost 90% banks and analysts and everybody betting on, you know, betting on 25 basis points, and generally they're right. Again, at 9 out of 10 times they're usually correct, and so. I think the banks have very good software and knowledge on the matter and interpreting Fed decision movement. And so if they're thinking, you know, 90% think 25, I think that's pretty, you know, it's pretty good margin. And yeah, so we got a Twitter poll. And again, we did a Twitter poll as well. We got about 51% of people on our Twitter poll saying 25 basis points. About 15 minutes ago, we did a YouTube poll. We got about 500 plus votes, a little bit over 500 votes. 46% of people think we're going to have a positive reaction. And so, yeah, I hope they're right, you know. But I'll also say it's pretty rare that we have a lot of bulls on these Fed meetings because a lot of Fed meetings, everybody's super bearish. So we'll stream the full thing live in real time right here. Okay. If 50, then banks should look out. Yeah, if 50, banks are in trouble for sure. This is one of the more polarized chats as well. You know, like some people expect 50, which again, I think is very unlikely. Some people expect 0, which is a little bit more likely, but I wouldn't necessarily say it's likely, if that makes sense. Yeah, if we do 25, technically that's a neutral decision. And so, you know, if we look at like what we did during the last one here, we put up like let's put a longer term 5-day chart up, or 5-minute chart. Let's put up yeah, this should be good enough. So we can put a 5-minute chart up here and look at the last rate hike decision, which was in February 1st, and see how the market responded to it. It looks like they responded overwhelmingly positive in February. So February, the rate hike decision was announced right here. You can see the big uptick in volatility from that, where we went up and down, but it was neutral. It was what was expected. And then when Jerome Powell started speaking, which was here at 2:30, the market ripped up like that. So that was the last Fed meeting, where we react neutrally because it was what was expected, and then afterwards we kind of flew up from it. Yeah, it certainly depends on what he says. Especially 25 is already priced in to a certain extent. It's what's expected, and what he says is going to have a high influence over it. It'd be interesting if they went negative. Oh, it'd be really surprising. We'll have a really brash reaction in one way, in the upward direction, I think, if they did. But I don't think it's very likely. But why not 50? Because we know for sure no one's going to lose money at banks. Because 50 is because it's not about whether people lose money at this point. If banks were already struggling over the last couple weeks, and the banks that were struggling, and some of them failed, even though they're small banks. And, a lot of people are speculating that this is going to make the big banks stronger. Regardless of that, people are going to be worried, and it's going to cause a trickle effect in the broad sector of banking. That's going to crash a lot of banks. A lot of banks are going to crash. That's going to trickle into the rest of the economy, and then it's going to make other things fail. And so it's going to have a trickle effect. So it's not like we can just say, oh, screw the banks, let's just do 50. I think that would be throwing a wrench in a lot of economic, stuff. And I think it wouldn't just affect banking. It would trickle into everything else. I think 50 is too much. 25 is neutral. And again, I get it. I'm not saying I disagree with the perspective of, hey, let's just rip the Band-Aid off, do a super aggressive rate hikes, curb inflation, and then, figure it out from there. I get it. Jerome Powell has actually said that that's not what he wants to do. He basically said that he did not want to just do a really aggressive rate hike, like 100 basis points or something, and then crash the market and then play cleanup. That's almost verbatim what he said. And so, I don't think they're going to do that. I think it's going to be more sustained rate hikes, but not super aggressive, to try to play middle ground there, and 25 basis points in that regard makes sense. All right, guys, we got about 35 minutes until the press conference. We got about 700 people here already. Hit the subscribe button if you haven't already. Bitcoin dipping down a little bit over the last hour or so. It's dropped from 28.9 basically down to 28.5. So it dropped about $400 a token there. So I think we'll do a crypto show after this, but you can try to see it without stream delay, but the amount of time it take you to interpret it is going to be sizable. We'll wait until we get a little bit more people here, and we'll show you guys. What's up, Wesley? What's up, John? Dude, but didn't the Fed inject $300 billion? Yeah, a lot of people speculating that QE, quantitative easing is back in that regard. And that's ultimately what sparked Bitcoin's big run lately. But regardless of whether they did that or not, I think if they continue the aggressive rate hikes, they're not going to be able to print money just forever. And so I don't think they necessarily want to do that. I think that weighs on public sentiment. So, yeah, I agree. Fun for the most part. I don't know. We could have high volatility, but I'm expecting high volatility. Could be some good trades in there somewhere. Me, I'm not sure yet. I've been patient sitting on cash. I'll wait for the trade to come to me. Good luck. You as well, Jake. Thanks, man. Yeah, I mean, I kind of do the same. I'll trade these, but I'll usually look for basically the way I trade these is I'll look for Jerome Powell to say something really polarized, and then I'll try to get in as early as I can and ride a piece of the move and get out before he says anything else that switches the direction the other way. Again, I'm not telling you guys should do that. That's a very risky trading style, to be honest. And I've been trading for years and years. And so, my risk is small there. I take very small size when I do that to kind of counter the risk in those trades. But, again, I would be careful if you guys try to do that. It's not as easy as it sounds, to be honest. Yeah, it could go up or down. I wouldn't make bets ahead of time. It's just risky. Yeah, for sure. I mean, that's another theory for sure, Ben. I think a lot of people are looking at it in that way too. It's probably a little bit of both. Will there be some volatility? Yeah, there's going to be some. It's going to be better than just basic market most of the time here, but uh, you know, how much volatility we don't know. I think if people are pricing in 25 basis points, that could be what this move of the last 3 days looked like. This big green move we've had over the last 3 days. Again, it could be people just getting baked into potentially 25 basis points or zero or whatever they think it's going to be. Again, I think I'm not saying it can't be outside expectations, but I think it's rare. And so I think betting that it is just kind of a gamble. And, you got a very low chance of it being right. But if you are right, it's a big reward, of course. It's a high reward. So, I get it, but I'm not doing it. Apple up to 160s, though. So Apple rebounding. GameStop completely choppy on the day. Market's pretty flat, too. It's basically been going between $397.50 and $400, so a $2.50 range today. Pretty slow. Not a lot of big movements here, going back and forth, up and down. Hey, nice MS. Congrats, man. Good trade, dude. You mean the February rate decision? We already did that a little bit. I can do it again if you guys want. Basically, here was the last rate decision right here. Hold on, let me find it. The last rate decision was right here. Choppy market leading up to it, similar to kind of what we have now afterwards. When Jerome Powell spoke, we ripped up big. Prior to that, since it was neutral, we were pretty flat, just kind of going up and down. And then when he started speaking, which was right here, the market reacted really positively to that. So he said some positive things. So again, a lot of the time the Fed tries to be balanced. We'll see. I really don't know. Hey, what's up, team? My theory is to crash in the old school way is impossible for a few reasons: options, pinning, and associated hedges by PC sellers and buyers and algo trading. Yeah, for sure. What's a good leverage to take tonight, in your opinion? I wouldn't do anything ahead of this. I'm not really... Again, we can gamble and just basically take a really big trade ahead of the meeting and hope that we're right on the direction, but I think that's a coin flip like trade that is not going to be a positive, profitable trade long term. Mostly gamblers doing that, unless, like, the only exception is maybe if you take like far outside the money options and look for like a really big move in one direction. So like you buy far outside the money put options and hope for like a big drop and then try to sell them into profit, maybe weekly options or something like that. Again, I'm not telling you should do that. Maybe the market just flies up from this. I have no idea, but that's the only justifiable kind of trade you might be able to find an edge in if you do it right. But it's going to be pretty low edge, I think, too. Yeah, straddle sell makes sense. Bitcoin consolidating around the volume weighted average price. And yeah, we got some time still. Again, SPY at 398.40s. Apple looking really solid right now. GameStop at 25, moving up. Yeah, and CPI came out this morning for England. It wasn't great, though. CPI came in higher than expected for England. Also analyzed a bit the inflation data. Some of the first signs that inflation starts to calm down. Some pretty positive signs. Doesn't show up really on the numbers. Market follows. Yeah, real estate's looking a little bit better. Car prices have definitely been better than they have been. They're still not great. I saw a dude trying to sell a 8-year-old car with the 8-year-old diesel truck with 200,000 miles on it for $50K, and it was like a. I'm not saying it's not a nice diesel truck, but $50K for 200,000 miles seems a little excess. So I think there's still certainly inflation and a bubble in cars, but it's not as bad as it was like a year ago. Same thing with real estate, I think. Yeah, new engine's different. 200,000 motor is still pretty heavy mileage. I know it's diesel, so they last a little bit longer, but still just ridiculous. I think people see the bubble, and I think a lot of people are taking the approach of, like, in real estate as well, where like, hey, I'm going to sell my house now, wait for the market to correct, and then buy back a similar property and pocket 40%. I think a lot of people are probably thinking of doing that in cars as well, where they sell their car, wait for car market to get a little bit better, and then buy it back. But yeah, I think it's going to be a little bit more difficult now to do so than it was, a while back. Yeah, well, there's always outliers. So if the car is taken well care of, some cars are going to last longer, but it goes by just basic average value of a car with that many miles on that's that old. And, it's going to be well below that, in my opinion. But yeah, definitely top 3 polls ever in the world. For sure, definitely top 3. Not saying it's right. I don't know about Tesla. Is he? We'll see. I hope it goes up. We talk about gold sometimes. I think, like if you look at GLD's been dropping down. Like, it's got an inverse relationship to the market for the most part. I think if the market goes down big, it'll be good for gold. You can look at gold here. SPY moving back up a little bit. Not a perfect inverse correlation, though. What's up, John? If zero, Tesla will probably go up because that's no rate hikes. That's good for business, but it's bad for inflation. If it's 25, it's a little bit it's a little bit lesser known. 25 is neutral technically, so like it could essentially do anything, where like some people might see it as positive, some people might see it as negative. We really don't know, what 0 or what 25 means. 25 is technically neutral, so it's like it could really go either way, where some people are going to think it's really good. Other people are going to think that, it's too much, and some people are going to think it's not enough. Some people want 50. So it really just depends. The timers for when the actual rate hike decision is coming out. Yeah, so the actual rate right now, it's 1:35 market time. My time's a little off. I'm in Central Time. I'm in Texas right now. So has the market discounted 25 basis points? I don't know. I think it's definitely priced in a little bit because that's what's expected. But how the market actually reacts to it, we'll see. It could go either way. There's always some, like, it's always baked in a little bit. The expectational rate hike is always baked in to a certain extent. It doesn't mean we're not going to get any reaction if we showed that, though. But, traders are traders. Yeah, for sure snow. Oh, crap, dude. Ugh. Oh, wow, I got really lucky just now. I was about the luckiest I could be. I had a towel right underneath where the soda spilled. I'm almost out of soda, though. Sorry, bro. Can you explain a little bit about the FOMC? Your channel is really helping for beginners here. Yeah, so I mean, the Fed raises rates to control inflation. If prices are really high, what they do is they raise interest rates. With the entire point of raising interest rates in that being to discourage spending. When people stop spending, prices go down to compensate for that. And so if you want to make prices go down, you got to stop spending. The way they stop spending is by raising interest rates. And that's really the only tool the Fed has. But the Fed, every 6 weeks, the Fed does a rate hike or changes the rate potentially, depending on how bad prices are, how bad inflation is. You know, if inflation short term is really bad, they raise rates more aggressively. You know, we've seen rate hikes at 75 last year and stuff like that. And you know, we've seen them recently at 25 and 50. And so if inflation's bad, they raise rates, but there's a counter effect to that. When you raise rates aggressively, it discourages everything, spending everywhere, not just in, you know, the markets they use to judge inflation. So it stops spending in stocks. There's an inverse correlation generally with aggressive rate hikes and stock price activity. And so if the rate is really aggressively or more aggressive than anticipated, then markets are generally going to react negatively to that. And vice versa. If it's less than anticipated, you know, markets are generally short-term going to react a little bit more positive to it. But again, the less they raise rates, the more inflation problems there potentially we could have in the future. And so every 6 weeks they raise rates. Right now they're expecting 25 basis points. So that's essentially what the expectational number is here for the rate hike today. And again, it's going to drop right at 2 p.m. So in about 22 minutes is when the rate hike is going to be. So, yeah, we'll see what happens here. Again, they were expecting a 25 basis point rate hike from 4.75% to 5%. And so when you read the report on the Federal Reserve website, that's what you want to look for. You want to see if it says 4.75%, that means they did zero. That means they paused rate hikes. If it says 5.25%, that means they raised it by 50 basis points. And that's going to, you know, market's going to dump if that happens. Probably. We don't know for sure. It's never 100%. But in that situation, the market's almost certainly going to fall. But it's incredibly unlikely. It's just not going to happen, most likely, you know. Yeah, we got 20 minutes. Timers in the bottom right. Hey, thank you so much for the donation. If 25 is baked in, what would the guidance, what would get the guidance baked in? Are you saying if 25, I'm confused about the question. You said if 25 is baked in, what would be the guidance baked in? So Jerome Powell is going to speak at 2:30. That's in about 50 minutes. So in 50 minutes, Jerome Powell is going to speak. My guess, and again, I'm not 100% sure. I appreciate the donation, Roberto. My guess is he's going to say positive, optimistic things because he understands the banking issues that we have going on. And if they do 25 basis points, which is kind of neutral, and then they say negative things, you know, maybe that makes inflation, maybe that helps inflation, or maybe it helps inflation sentiment, but I don't know. I think they'll probably say positive things because we already got some problems over the last couple of weeks with regards to banking with Silicon Valley Bank, FRC, you know, Signature Bank. I think a lot of people are already scared. And I think if they, you know, I think the market's still pretty neutral over the last couple of weeks regardless, but I don't think they want the banking fears to spread necessarily. People start losing confidence in the little banks. It will affect the entire market for sure. Make fear, you know. Make a lot more fear. What would be the guidance baked in of future rate hikes? Now, if we do 25, the question, or if we do 0, you know, the most likely outcome for the next rate hike, in my opinion, is going to be 25 again. So I think we're going to only pause for one session of rate hikes, one quarter. every 6 weeks. So 1 6 week period. I think that's the only amount of time they're going to pause. I think after that they'll probably do 25. But we also have some stuff coming out next week. So next week we have GDP coming out on Thursday, jobless claims on Thursday, so kind of like a set of unemployment data, as well as the PCE deflator Friday. Those are inflation net metrics as well. People look at GDP for sure, but the PCE is actually what the Fed uses to gauge inflation. Again, we'll stream it all on Friday. It drops at 8:30 Eastern Standard Time. Not this Friday, next Friday. But that's actually what Jerome Powell and the Fed use to judge how bad inflation is. So that'll be, that'll be relevant to inflation stuff too. But how the market's going to react, I have no idea. We'll have to wait and see. 50 and everyone will be surprised. I certainly will if we do 50. Again, I'm not saying we don't, but I think it's unlikely, All right, we got 17 minutes. All right, guys, Apple break it up. Market's rebounding a little bit ahead of this, too. So, again, very flat market. Looks kind of like the last one where we were sideways until the rate hike decision. Here's a 1-minute chart if you guys want to see a 1-minute chart a little bit clearer. But we've been pretty sideways today. We are pretty neutral. Previous closing price right there. We're a little bit below it, but less than $1 below it. So pretty apprehensive market, I would say. Yeah, I mean, that's my guess too, Demetrius. I'm not 100% sure, but yeah, I think he's going to be dovish because of how banks, got hit the past couple weeks with Silicon Valley, Signature, FRC. Yeah, I mean, 50 or 0 will be the best for volatility for sure because you could it's not going to be easy. You never know, man. One thing about the market is that it always humbles people in that regard. Like a lot of people enter the market and they think they can just wait for a company to do positive EPS, positive sales, and buy it right after earnings. If Nike showed you anything, Nike posted better than expected EPS, better than expected sales number. And because of one small nuance in Nike's earnings report that a lot of people didn't see, Nike actually dropped fairly large from a good EPS, which is good profitability and good sales revenue. So you never really know. That's something you learn very quickly is that the market's not as easy to predict as people think it is, especially with regards to economic data. If economic data so for sure moved the market in one specific direction, everybody would be millionaires, in the market, because it's very easy to look at this and learn everything I just said over the last hour. But it's just not that easy. But with rate hikes, it kind of is. And inflation, it generally is as well. But another weird nuance is like PPI came in lower than expected last week. Generally, that's inflation data. So inflation came in lower last week, which is overwhelmingly seen as a positive thing over the last year. Yet when that happened, the market tanked. And so again, market tends to humble people. Sometimes it's not as easy to figure out what's going to happen as people think, It's not going to be 75 for sure, Han, No, I can't react it. I can tell you the most likely outcome Costa, but I'm not going to give you exactly specifics for liability reasons. Costa says, hey, can you answer the following question? Only positive or negative reaction if rates are 0, 25, or 50. I have no idea which way we're going to react for any of those numbers. I can give you probability numbers. But even still, regardless of that, not an investment professional. This is not investment advice. I have no idea what I'm talking about. I might be wildly wrong about everything. If you copy me, you're liable for your losses because I have no idea what I'm talking about. Now, with that said, not the way. If we do 0, we'll probably go up. If we do 25, it's neutral. It's flat. It's a question mark. We have really no idea. It depends on if we go neutral, it'll probably depend on how Jerome Powell speaks during the press conference at 2:30. If he's positive or negative or hawkish or dovish or whatever it is, that'll influence the market's direction. If it's 50, market will probably go down, and then maybe if Jerome Powell says positive things, it comes back. Maybe not. That part we don't know for sure, but that's probably the guide of it. But again, I have no idea. I might be wildly wrong about that, and the market might be completely opposite to that. I really don't know. show P&L. Bro, my channel's called Beginner Trading. I'm not even claiming to be a profitable trader. I don't even claim to be a good trader. I'm definitely not an expert. So yeah, I'm not showing you my P&L. I mean, I think, what am I? I think I'm down small on Thinkorswim, but I'm green on the year, you know, and I wouldn't be able to lie about that on Thinkorswim. I'm green on the year on TD Ameritrade, swing trading and day trading. But and if I lied about that, I could get in trouble. But yeah, I'm not going to show y'all anything. I don't need to. This account's a fairly large account. I'm not really trying to show my account information. I've got about 160,000 in buying power on this TD Ameritrade account. I don't really feel like flashing any of that stuff to anybody. Yeah, I think a lot of people want them to be aggressive with their rate hikes. But again, there is going to be a consequence to that in markets. It will drop tank markets. Yeah, definitely top 3, you know. Yeah, I think banks are nervous for sure. I really hope it's 50 to 75. Yeah, it's going to cause a trickle effect in everything though. For the US dollar to get stronger, I mean, generally there's an inverse correlation between the US dollar and the stock market. And so by the US dollar getting stronger, that essentially means that the market goes down lately. It's not 100%. Let me see what the Dixie looks like today, but yeah. So I mean, here's a great example of that, right? So this is really the opening bell. But I guess there's a positive correlation today. Let me see. This is 8:30. So this is the opening bell. Okay, so let me see. Let me zoom out. Okay, so yeah, you can see the inverse correlation here. So here is 8:30. Right? So here's 8:30. So the market dropped at the open and then ripped up later. The Dixie went up at the open and then dropped later. And so there's somewhat of a negative correlation between the dollar index and the market itself. It's not exact. It's not perfect. But, you know, again, generally, when the market is really strong, the dollar goes down. So, bro, again, for beginners here in simple words, what are we expecting within the US dollar currency pair for the Feds? If the market is positive, if the SPY and the S&P 500 move up from this announcement, the dollar index will probably fall. And vice versa. If the market moves down from this announcement, the dollar index will probably move up because more inflation fears, the higher the dollar gets, and the less confident people are in the stock market. Another inverse correlating reason for the dollar index in the market is that if your cash is gaining value, you're not going to buy the S&P 500. You're just going to sit on your cash because your cash is gaining value. If your cash is losing value, you're more likely to say, hey, I'm not going to sit on this cash anymore. I'm going to take it. I'm going to stick it in the S&P 500. And so in that regard, you know, there's an inverse correlation a lot of the time with this, but it's not an exact thing. It's not a constant, you know, thing that's always true. It's just generally, is the best way I could put it. You can watch it right here, Julian. We're going to stream it live here. Yeah, I think Jerome Powell could say something like that. I mean, he said basically something like that. Inflation is still high. I'm sure he's at least going to say inflation is still high at least once in the press conference that he does. That's what they generally say. He'll probably say that in the report as well. Can you explain the percentage? Yeah, so again, right now, last time the Fed raised to 75 to 4.75 the last time. So the last time the Fed raised it to 4.75. If the answer is 0% for rate hikes, then when you read the report on the Federal Reserve website, it'll still say 4.75. If they raise it by 25 basis points, then it'll say 5% relative to 4.75. From 4.75 to 5 is 25 basis points, 0.25. If it is 50, the final number will be 5.25. So it'll be 50 basis points, which is 0.5. 5.25 will be the final number from 4.75 to 5.25. That's 50 basis points. And so that's how you do the math behind it. And when you look up the data here, I'll show you guys where you do it. Let me find it. All right, so you can go back. You can go to the Fed's website, and we'll look. I'm gonna post this in the description so you guys can see it. All right, so this is in the description if you guys want it. All right, but you go to the website to find it yourself. All right, here's 2023. The last one we did was February 1st. The last one we did was February 1st. And so you can see, you can find the HTML file like this, and then you scroll down and you can see they raised it to 4 3/4, which is 4.75, which was from 4.5. So they raised it 25 basis points. Or no. They raised it. I can't remember how much they did last time. Was it 50 basis points? But you can see they raised it to 4.75. Right. So when you read the report coming out, if you go out here and you look at the March 22nd one, it'll show up right here. It'll show up right there. And you'll be able to click PDF file. HTML will be right there. And you'll be able to read it just like this one. Except right now we're at 4.75. And so if you click this and you go down here and this says 5 at the very end. So when it says 4 3/4, or whatever it says to 5 here, then that is going to mean 25 basis points. All right. So that is going to mean 25 basis points. If it says 5 1/4, that's going to mean 50. If it says this same number right here. So if this number is the same right there, if it's 4 3/4, then that's going to be 0. Right, but I don't think it's going to be that. It'll probably be 4.2. It'll probably, if it says, I'm looking for 5, I think it'll probably say 5. But again, we don't know for sure. But that's how you find it. If you guys are wondering, that's how you find it. Last time it was 25 basis points. Oh yeah, sorry. Yeah, I cover every one of these, so I get them kind of mixed up. I've been doing it for long enough to where, but yeah. All right, we got 5 minutes. 5 minutes. We still got about 5 minutes, about 5.5 minutes. So I think my timer's about 30 seconds early, but that's okay. Yeah, I use a lot of different ones. And let me know what you guys think is going to happen here. It'll be fun, man. We'll see what we get. We're also going to throw it in sub-only mode. So if you haven't already, hit the subscribe button, guys. You know you want to. Do it one time. We'll cover the entire press conference here as well. We cover the full Fed meeting live right here every time. We cover all the big earnings, all the big FOMC meetings, all Jerome Powell press conferences, the CPI report, PPI report. We cover it within seconds. We get thousands of people that tune in for these because we explain it in an understandable way and we cover it very quickly so you can react to it fast. Do you have any plays for today? I don't really give out stock picks. I think that's kind of a sleazy market that most people are getting taken advantage of trying to follow stuff like that. It'd be a lot easier just to learn yourself. If you don't have the time to learn yourself, invest in something else. Like don't just follow stock pick services. They're usually pretty scammy. Some of them are good, but it's gonna be hard to find the ones that are. Yeah, crypto, I'm not really sure the reaction, Yappy. I really don't know what's going to happen there because I think the market has been trading inversely to crypto over the last week or two because of banking worries strengthening for crypto, as well as like crypto and Bitcoin turning into like a hedge. And so Bitcoin's been pushing up today while the market has been red most of the day. So with regards to like how crypto will respond, I really have no idea there. I think this is a little bit more nuanced than that. I think I think there's an argument for both reactions. I think you could say, hey, well, Bitcoin usually follows the SPY. So if the SPY is really weak, Bitcoin will be really weak. And that's a reasonable conclusion. You could also say, hey, Bitcoin is positively benefited from bank weakness, because when banks are weak, people are like, screw banks, I'm going to Bitcoin. And so you could argue an inverse, relationship right now today because of banking weakness over the last couple of weeks, bringing people to Bitcoin. Again, both of those are reasonable theses. I just don't know, what we're going to get there. It's too nuanced today for that. It's too hard to predict which reaction you're going to get from it. Human psychology in that regard is a little bit touchy, to really judge accurately and consistently, like with something like today. Yeah, Bitcoin bouncing back up to over 28.6K. We'll see if it breaks 30K. It's been really strong over the last couple, All right, guys, we got about 2 minutes. 2 minutes. Report's not out yet. It's probably doing 25. I think a lot of people are probably trying to act like they've got insider information, and they're just going to say 25 basis points because that's almost certain to come out. But again, we'll watch the market reaction. Market's starting to pop. We got about 2.5 minutes left, a little bit less than that. All right, guys, get ready. Tell us the future one time, 25 basis points. Have no idea if that's right. I might be wildly wrong, but if it's right, I'm definitely, a genie over here. I can see the future. You know what I mean? All right, guys, we got about a minute left, or about 2 minutes actually, but I don't know if he's going to talk about Silicon Valley. He might, but I think he's going to try to be positive. But who knows, man? We'll see if he is or not. If the Fed reports came out, you see a huge move in the market, or at least a quick reaction, and that's just not what we got so far. So maybe, but yeah. Make sure you click the live button next to the play button. Make sure you're caught up on stream too. So make sure your stream looks like this as well, team. We got about a minute left. Make sure your stream looks like this. Make sure your live button is red and not gray. That means that you're caught up and there's no delay. I didn't mean for that to rhyme, but mixtape coming soon. We got about 45 seconds left. 45 seconds left. All right, let's watch the market here. You got the SPY on the right, Bitcoin on the right. Bitcoin's moving up. Here's the SPY at 398.70s. All right, guys, let's get ready. All right, here we go. 20 seconds. Again, we're going to try to look this up as fast as we can. Bear with me. We got all our different sources up. All right, guys. And there is the dot. We're waiting to see if we get anything. Looking at it now, and we came in. Still doesn't show yet. Let's look. All right, I'm gonna have to read it myself here. There it is. All right, so we came in at 25 basis points, 25 basis point rate hike. They decided to raise the target range for the federal funds rate from 4 3/4 to 5%, 25 basis point rate hike. And as expected, market's loving it, guys. Market's pushing up right now up to 400 on the SPY. Bitcoin is ripping up to 29,000. And so it looks like there's a positive correlation between Bitcoin and the actual market. But yeah, 25 basis point rate hike. Again, no pause. 25 basis points is at 5% right now. 5% was what was expected. It means 25 basis points. Told you guys. I mean, I tried telling everybody today, 25 basis point rate hike is pretty certain in that regard. I mean, that's usually what we're going to get. If they predicted, if 90% of banks and everybody else expects it, they got better information than we do. It's pretty likely. And again, 5% is what we're at now. 25 basis point rate hike. We will put it up on screen. We will put it up on screen, but yeah, 25 basis point rate hike. All right, as expected. Again, 25 basis point raise, as we expected, as we told you guys. Market initially reacted positively. We're over 400 right now, which is good. Market's loving life, flying up here. Yeah, again, I told you guys, like, there's a lot of people who want different things to happen, and I think confirmation bias is strong. And so you got a lot of people saying, oh, no, the market's going to crash. We're going to do 50 or 75 even. Or you got some bulls that say, oh, I want the market to go up. We're going to do 0. I think 25 was the right decision in that regard. I think 25 was the right decision. And the report looks like this. We'll go ahead and read it right now so you guys can hear exactly what they say. They say recent indicators point to modest growth in spending and production. Job gains have picked up in recent months and are running at a robust pace. The unemployment rate has remained low. Inflation remains elevated. I told you guys they would say it at least once. The U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for household and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. The actual press conference is in about 25 minutes, too, and we'll stream the entire thing live. Recent developments are likely to result in tighter credit conditions for household and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 4.75% to 5%, which is 25 basis points. The committee will closely monitor incoming information and assess the implications for monetary policy. That is it. But, yep, 25 basis point rate hike as expected. All right, guys, market is pretty flat, which, again, this was as expected here. This rate hike was as expected. Very flat, very neutral, as expected rate hike. And so, yeah, we'll cover the full press conference live like we always do right at 2:30, like we always do, team. So be ready. We will cover that live. We are getting ready to stream that now. All right, guys. So we got about 4.1 thousand people here, guys. 4.1 thousand people here. We appreciate it. We're getting ready to stream the actual press conference, which is live. Again, the actual press conference is going to be live here at 2:30. We'll put this up on screen so you can see it. 2:30 p.m. Eastern Standard Time. So yeah, 25 basis point rate hike. And again, let me know what you guys think. Catching up on chat. We got almost 4,000 people here, so it's getting kind of fast. But yeah, let me know what you guys think. No doubt, crypto. Yeah, market's pumping up. Crypto hit 29K today. SPY just ripped up to 401s right now, flying up right now. 401s as we speak here. So kind of crazy with regards to the move up here. All right, guys. Market just ripped up over Bitcoin, hit 29,000. Again, SPY at 4,000 or at 400 plus. S&P 500 over 4,000. Yeah, I mean, guys, listen. I think sometimes people can get upset if you're just reporting on what's happening, just because they disagree with what's happening. The market's moving up. You know, SPY over 401s, Bitcoin just tapped 29K. The rate hike came in as expected. None of this matters though, because what matters the most is what Jerome Powell's about to say. You know, so the rate hike could be interpreted as great, but what he says in 20 minutes, 23 minutes is going to impact all of this much more, in my opinion. Market's looking strong right now. And if Jerome Powell comes out and says, you know, it comes out and says that we're seeing positive inflation signs, great. That's going to make the market rip up more. If he comes out and he says some really hawkish things, that's going to make the market tank more. The big thing is that they did it as expected, which is what we told you guys was pretty likely, you know. So, yeah, let me know what you guys think. Market tap 401s right now. Yeah, we're going to stream the full press conference. Let's see how the dollar reacted to it. There's Bitcoin. Yeah, so again, we were absolutely correct about everything. You know, we had some people disagreeing with us, but I mean, look, we told you guys there's an inverse correlation between the dollar index and the market usually, and that if the SPY reacts positively, the dollar index will react negatively, and that's exactly what we got. SPY ripped up, which is the S&P 500. The dollar index fell down some. And so, yeah, we'll see. Also, guys, if you want to help support your boy here, check out TopStep. TopStep is a funded account program for futures. And so if you want to trade this volatility, you can essentially trade the SPY, which is the S&P 500 with no PDT rule in futures. And TopStep is the easiest way to get started day trading stocks without putting on $25,000 in buying power to do it. What TopStep does is they give you a demo and they test your profitability. It's very cheap. It's less than $140 a month. If you pass their testing, if you can hit their profit target while following their rules, they fund you between $50,000 up to $150K with a 90% split. So you're still keeping 90% of your profit if you're good enough to pass it. I think most people are not going to pass it. And I think that's the point, is that it's so much cheaper to try that out and lose than it is to put up, you know, $25,000 yourself and risk losing that. And so if you pass it and you're good enough, you still reap most of the benefits, but you're not taking on as much risk. It's a perfect middle ground of pressure to test yourself. And if you're good enough, you can get funded. If you're not, you're only down $140. And so I think that makes tons of sense if you're trying to get started and learn. And if you want to check them out, here is the link. They are a sponsor of mine. I'm certainly biased in their favor because they pay me money and they're a sponsor of mine. But check them out here if you want to help support the channel. Yeah, well, I mean, how many day traders are profitable? I mean, of course, most day traders are going to lose money. I mean, that's pretty standard, right? That's called TopStep. Link is in the description. Just posted the link as well. That's called TopStep. All right, guys, gold ripped up from this date as well. So it looks like gold, crypto all had a positive correlation with the S&P 500 today. What are bank stocks doing here? Here's FRC. Pretty flat. You know, Jim Cramer said that this was going to be weak today, and of course, or yesterday, I think it was. And of course, it's got to prove Jim wrong. My guy is just the unluckiest dude ever. But again, WAL. Good day for them too. I don't know if they're really liking this rate hike decision though. They should love it. Honestly, I think a lot of them expected zero though, so maybe they're just not really happy about raising rates at all. But I think this is probably one of the better case situations that could have happened, to be honest. All right, guys, SPY at 400s. So pulling back a little bit. You can see from this response, we've ripped up big. And again, the press conference is going to start at 2:30. That's the most important thing here. So stick around. Press conference is in less than 20 minutes. And again, that is probably the more important thing here relative to all this other stuff. Yeah. I mean, again, whether it's good or bad is subjective. Of course, you know, some people are going to like it. Some people are not going to like it. Some people are going to say it should have been more. Some people are going to say it should have been less. Some people are going to say it's like Goldilocks and it's just right. Regardless of that, we got to look at what Jerome Powell says today. Jerome Powell is going to have a big influence, you know, regarding what he says. Not just he's going to read a generic statement that reads something like, hey, you know, the labor market is resilient, unemployment remains low, inflation remains high, you know, which he said every single one. He's going to say something like that, right? But he's going to follow it up with a Q&A, and that Q&A is going to influence things as well. But it depends on what he says. You know, he's going to be a little bit more in detail about it. Then they're also going to do the Fed minutes report in a couple weeks. That'll give more detail to what he decided to do today. So, hey, thank you. Thank you, Dionysia. I appreciate it. Thank you. Appreciate the support. Jerome Powell is not speaking already, man. Again, I can prove it very easily here. All right, you ready? Let me prove that he's not speaking yet. Where did I watch the meeting last time? Yeah, he's not talking. It's at 2:30. This is standard, guys. This is every single thing. Every single one. It's at 2:30. Every single Fed meeting, it's the same. 2 p.m., the rate hike decision's announced. 2:30, they do a press conference. He's definitely not speaking yet. Again, they haven't even posted the meeting yet. So... yeah, you can even see this here. So like here is here is the actual press conference channel. Yeah, so they are on hold. And so again, here is the actual press conference. Not live yet. Look, watch live March 22nd at 2:30. So not live yet. Stick around. We'll stream it. 25 basis points were the results. It might say it right underneath me. It could say that. It might say it. I'm definitely one of the top 3 trollable streamers. But I mean, what you also have to understand is like people control me. People tune in for the drama regardless. And so like I'm kind of making money on the back end of that. And so troll me if you guys want to troll me. It's okay. You know, you'll get banned for life and I'll hate you forever, but I'll probably make money while you do it. So, you know, cheers to you. He will lower the press conference again, I guess. No, he's not going to influence it like that. He might give some he's gonna he is gonna give some words. I think he's gonna be positive. I don't think he wants to hurt banks, you know. So again, we can look at it right here. I don't think he wants to hurt banks. Can you show us what Powell says? Powell's gonna say something like this. He's gonna say, the labor market remains resilient. The unemployment remains low. Inflation remains elevated. Is what he's going to say. He's going to say something like that. You know, he's saying because of this, we have decided to raise the federal funds rate 25 basis points to 5%. Then he's going to be asked a bunch of questions, and that's going to influence the market heavily. Dude, Powell's not talking, and if you keep pretending he is to try to get people to go to the other stream, and you'll get banned. He's not talking yet. It's at 2:30. The press conference not even starting yet. At 2:30, the press conference starts. GameStop is up already 42% today. Yeah, GameStop, surprising beat for GameStop, honestly. Look, here's the press conference. We're completely live. We're waiting for it to start. We're banning everybody out here, The unpress conference. Top 3 unpressed conferences in the conference world right now. SPY right around 399.50s though. Still technically green on the day, but as we said we might be, we're pretty flat and neutral leading up to this. Yeah. I don't know. I think Powell will probably be a little bit friendly on banks. I don't think they want this to spread under their watch, right? I don't think they understand, like Powell understands certainly that if he gets a market crash under his watch, a lot of people are going to point the finger at him. And so I don't think he necessarily wants that, even if it doesn't do the most for inflation short term. And so I think if Powell has a bias, I think that's where his bias is. I think he's worried about the perception of things because he doesn't want to crash under his watch, right? He even said almost verbatim that he did not want to do a super aggressive rate hike situation and then play cleanup afterwards with regards to, a crash. Right. And so I think he's going to take the conservative approach in that regard, which I think makes sense. It's probably the right move. Again, you're going to have a lot of people who, frankly, don't have a lot of money invested right now, who are going to say, raise it 75, do it now. Maybe they're holding put options. And maybe that's the right move for inflation terms, right? Maybe that's the right decision. I don't know if it's the right move. I don't know. We'll have to wait and see what happens. I told you guys I predict the future. Didn't you say 0, Trance? Ban is Barney Rubble's kid's cousin. I like it. Hey, what's up? What's up from India, man? Hey, what's up, man? I'm in Texas. Good to see you guys. Glad you guys joined the stream. We appreciate it. Hit that subscribe button. We cover all the major economic data completely free right here. Watchers get trolled on the regular. But we also cover the data incredibly quickly, and we get thousands of people tuning in for it. So, hey, hit that subscribe button if you haven't already. Hit the notification bell. We appreciate it. Please, will market go up based on what? Market's moving up right now, over $400. Again, press conference still hasn't started yet. We're waiting for it. All right, guys. So, yeah, they haven't even posted the press conference yet. They got the HTML page. Again, if you want to read what the actual thing said here, you can read it right here. It says recent indicators point to modest growth in spending and production. Job gains have picked up in recent months and are running at a robust pace. Unemployment has remained low. Inflation remains high. U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The community remains highly attentive to inflation risks. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. And in support of these goals, the committee decided to raise the target range for the federal funds rate to 4 3/4 to 5%. The committee will closely monitor incoming information and assess the implications for monetary policy. That is what the actual statement said. And Jerome Powell will say some type of variation of that when he speaks. But again, they're going to ask him questions. He's going to be a little bit more detailed with it. And so that's kind of the nuance of this that will influence everything as well. So we'll see what happens. But yeah, that's basically what's going on. Definitely top 3 readers in the world right now. Top 3 for sure. And yeah, again, we'll see what happens. 25 basis points was pretty certain. Again, if you look at what the bank said, and again, you can try to, again, I always kind of chuckle at the people who think that they know more than the banks, right? Every time we get a rate hike prediction, people are like, nah, man, the banks are wrong. We're going to do 75 basis point rate hike. which is just far outside what could have happened. But yet people still make those predictions and they're wrong almost every time. And again, generally the banks have much better data tools than we do, for sure. Like they know way more than any of us, and me included. And so in that regard, betting against the banks is silly. They know 90% of them thought that we were going to do 25 basis points. In that regard, it was almost certain that we were going to do 25 basis points. If we didn't, it certainly wouldn't be 50 or 75. It certainly wouldn't be 75. It might be 50, unlikely. 0 was more likely at about 10%. But none of the banks thought we'd do 50 or 75. None of them did. And so, yeah, we'll see what happens, guys. Press conference starts in about 8 minutes. We will get the timer up here and I guess do the press conference one. But yeah, that's basically what's going down. Put that right there so everybody can see it. Why is the market flat? Because the federal funds rate hike was flat. It was as expected. It was basically what they expected it to be. So that is essentially, why the market was sideways leading up to it, is because, the rate hike was technically neutral. Yeah, Frankie. I mean, usually that's what the market does. I look at the market every day. I've been doing it for years and years and years. Generally, I buy dips. And when everybody's saying the market's about to crash and stocks are really cheap, I usually buy them up. And when everybody's talking about how the bull market is back and the market's back, I usually just sell all my swing trades. And honestly, like I said, I'm green on the year doing that. So it kind of shows you when everybody's saying the sky's falling, that's probably not the best time. Hey, baby. Yeah, you want to come say hi on the stream? Come on, man. You want to come on the stream? Come on. I'm making Carol come on stream. She doesn't have to. You don't have to, babe. You don't have to. You should, though. You look good, Contrarian is good. Yeah, well, the market is generally gonna do the opposite of what a lot of people think. I had 5x, so the federal funds rate was 25 basis points. So
that's what it was.
Yeah, so it was neutral, which is what the banks know, and the banks know. More millionaires are made when the market sucks, right? 100%. You buy the dip, you hold for 10 years in blue chips. You stop listening to everybody telling you a crash is going to happen every week. They might talk smack at me and tell you I'm a perma bull or whatever it is. Honestly, I'm pretty flat right now. I could have taken advantage of this. I didn't. If I was a perma bull, I'd be bullish right now and long. But I really don't know what's going to happen here. This is one of the more sideways. Reports, I think. By the blood, yeah, when blood's running in the streets. Basis point means how much they're raising interest rates. So it's how many basis points they're raising interest rates.
So does that already happen? They already gave.
So they raise rates, and then at 2:30 they're going to do an actual press conference about it. So Jerome Powell's going to speak at 2:30.
Okay.
Big Papa. That's what they call him. The big man, Big Papa. He controls everything right now. I mean, it's him and a bunch of other people, He's got his gang of people over there at the Fed that control things. Everybody hates him. Honestly, it's a tough job. He only gets paid about $200,000, which I'm not saying that's not a lot. But like, to put it into perspective, that's around what I make running this YouTube channel. I'm not trying to brag. I'm just saying I kind of feel bad for Jerome Powell because he just gets crapped on daily, Oh, this is the Donald Duck song. But that's a tough job to do for $200K. I'm telling you. I mean, I'd take it in a heartbeat, but
I think you would regret that.
Oh, I probably would. I can't stand YouTube trolls, right? You think I could be Jerome Powell for 5 minutes, dude? I would hate it.
And you'd have everyone hating you.
Yeah, the market goes up, nobody gives Powell credit. The market goes down, everybody got their pitchforks out, angry at Powell. I would hate that job. Without question. Yeah, definitely top 3. Yeah, definitely top 3. Right. Listen, that's what you heard me say. Zach says his net worth is 200 mil. You heard me say I would take the job in a heartbeat because there's other perks outside of, base salary. Y'all know what I'm talking about. I can't really talk about it, but y'all know. All right, baby.
Well, good luck, everyone.
All right, everybody, thank Carol for coming on stream. She did it. She came on stream. It's the first time in a while.
I know. Yeah, it's been busy.
Yeah.
Kids keeping us on the go. So.
Yeah. Yeah, for sure. Not for his job, dude. Yeah, the perks are certainly there. So
All right.
All right, baby.
All right.
All right.
Bye, everyone.
All right, love you. All right. I got Carol to come on stream. She never comes on stream. Anyways, we got the Fed actual press conference coming out in about 3.5 minutes or so. You can see cars driving around. Is she interested in the stock market? Not really. I wouldn't say she is. She knows about it just from hearing me rant about it half the time, but you know. Is she watching Apple Daily now? All right, guys, 3 minutes here. 3 minutes before the press conference start. Again, let me know what you guys think is going to happen here. It's interesting. We'll see what happens. I'm waiting for it. All right, guys. Again, Powell's going to start speaking in about 2.5 minutes. We got it ready. Let me see if they posted. I actually like the native player a little bit better. Let me see if the native player is posted yet, which I don't think it is. Nope. And then again, weeks after this, so every 6 weeks, the Fed does what they did today, which is raise rates, lower rates. They announce a rate hike decision every 6 weeks. And then weeks after that, we do what's called the Fed minutes report. It's a just like this was an HTML file, the Fed minutes report is a little bit stronger breakdown, a little bit more thorough breakdown on why they chose to make the decision that they did today. So that's essentially what happens. So that'll happen in 3 weeks, 2.5 weeks. Market's still right around $400. We still got about 2 minutes left. You mean if they pause for the next meeting? Yeah, I mean, I think that's what everybody's going to be hanging on. I think the Fed minutes report will say that too. She was starting to get into it free, but it's hard to keep her attention that long, you know. And with regards to the stock market, you know. She's not a numbers person, you know what I mean? She's smart, you know, everybody's smart in their own way. She's definitely smart in a lot of ways, but, you know, I'm kind of the numbers person. She's kind of sciencey, you know. I'm not sciencey at all. Anyway, SPY up to 400. We got the actual press conference. Should be starting pretty soon here. Let me get 2 of them up just in case, so we actually yeah, still nothing yet. All right, so yeah, we're just kind of sitting back waiting for them to start. They should be starting anytime now. Will your son take over your YouTube channel once you become an old man? If he wants to, I hope it lasts that long. But, you know, to be honest, I can't imagine I'm going to do it for that long. You know. All right, guys. Here we go. See, everybody that said Jerome Powell started talking already here. I'm going to go ahead and mute the music, and we're going to play this. Y'all could hear the music, right? Do I go to the gym every day? No, not every day. Every day is not really good for muscle activity. I mean, you can go 4 or 5 times a week, but every day you're going to run out of muscles to target unless you're just targeting one specific exercise daily, which doesn't really make that much sense. You know, I probably go 4 times a week, maybe. You know. All right, here we go. There he is, Big Papa.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector.
Oh.
In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening in credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation has been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector. And that is, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation. And I assume that, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Go to Rachel Siegel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next.
and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong. It is sound. It is resilient. It's well capitalized, and I really don't see that as at all analogous to this.
One other question: would you be open to an independent investigation separate from the Fed's probe?
I welcome that. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome when a bank fails their investigations, and of course we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky. So do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation.
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic. And then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really, no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements. But it seemed to be the right place. So with the FDIC, we're lending to the. In effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC. So there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is, and we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer term securities. Large scale purchases of long term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating. But, nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past. And it does kind of suggest that there's a need for possible, regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from Market Watch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect it seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Just the mic, please.
That's right.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation. And we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. That's and I guess there were 6 of them. So
and getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question, and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So that's I think that's what you think about. What can we do to make sure? But again, that's not for me to answer
So you
today.
don't have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review is going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if
Yeah,
credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say.
Unlikely.
So, thank you very much.
All right, guys. So that is the rate hike decision today. Really interesting ceremony here. You can see the SPY has been pretty neutral, pretty flat. We went up really big and then we're down really big. Now we're back up a little bit. Let me know what you guys think. Tomorrow will be an interesting day. Tomorrow we do have jobless claims numbers coming out, so kind of like a set of unemployment data. Hit the subscribe button. We cover all this data very, very quickly every single weekday morning right here on YouTube. And again, guys, if you want to help support the channel, check out Top Step. Top Step is the most legit futures funded program. If you want to trade this volatility, you can see on Top Step today, I am up about $700 trading this, about $700. I think sometimes you can just play off of their words. I talked about it this morning. And if you want to day trade the S&P 500 in futures, which is essentially the SPY, you can see the E-mini is the same thing. You can get funded on Top Step if you prove your profitability. So they test your profitability in futures. There's no PDT in futures. They give you a demo, and if you can hit the target on their demo while following their rules, they fund you between 50 to 150K with a 90% split. It's the most legit futures funded program in the world. It's really, really beneficial for traders. And stick around. We're going to be doing a crypto show right after this. But it's really beneficial for traders because most new traders lose money. And so this is a way you can get exposure to it, test yourself, still have some pressure, but not risk thousands of dollars like a lot of traders are going to need to do. But again, there's no PDT in futures. The base package is $140. If you want to check them out, you can get 20% off if you use my link. Great way to help support the channel. Great way to get exposures to day trading and learn to day trade without taking on as much risk as most people end up doing with futures and stocks. If you want to check it out, here is the link. Again, great way to help support the channel. Again, I traded this. I'm pretty green on that. There's the link in chat. Also, guys, check out Chart Prime. Another one of my sponsors is Chart Prime. You can see they give you custom trading view signals and alerts here, and look at how accurate these have been. Okay, so just to put this in perspective, you can use this in stocks, crypto, forex, futures. They automatically document support or resistance. Their oscillator is a little bit better than the VWAP in my opinion, and it's their own in-house one. And look, you can see double engulfing candle and reversal up signal were bouncing up just from that. It literally just gave that signal 5 minutes ago. You can see it was literally called the very bottom here, possible reversal up. You get a bounce. You can see all these bearish hammer candles right after the announcement. They literally predicted the drop. You got a reversal down, drop. To zoom in a little bit more to show you how effective this is, because before this volatility came in, you can kind of zoom in and see how accurate these were. Again, this one called the very bottom. I can't guarantee you're going to make money from these. They're a sponsor of mine, so I'm biased in their favor, but you can kind of see I can't fake what I'm showing you. They are surprisingly accurate, and you can use them on any time frame. You can use them on stocks, crypto, forex, futures, whatever you want to use them on. It's called Chart Prime, and it's incredibly cheap. It's $35 a month. If you want to check it out, here's the link. They don't repaint. Look at the 5-minute chart. Wow, that's really impressive too. Look at that. So possible reversal down, huge drop. Possible reversal down, huge drop. Literally called the top of those here. So you can use them. I like using the hourly time frame as well. But if you want to check them out, link is in the description for that as well. Here is the link for Chart Prime. Here is the link for Top Step. Again, I'm biased in their favor. They're sponsors of mine, so I'm certainly biased in their favor. And again, we're going to get ready to start the crypto show. As soon as I close down this stream, it's going to bring you to the crypto show. If you are on mobile, it's youtube.com/beginner crypto. And so if you want to, join the crypto show, there's the crypto link right there. But again, you won't have to go anywhere, because as soon as we close this stream, immediately it's going to start the crypto channel, which is right around now. And so again, I'll see you guys over there. Good luck. Again, I'll see you guys over there. We're starting that stream right now. As soon as I close down this stream, it's gonna bring you to that one. But yeah, good luck. Links are in the description. Check them out. And yeah, ending the stream now. I'll see you guys over there.